Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten, jumping into the charts on this Monday, August 22nd. What a terrific day for our swing trading accounts. First off, I want to say congratulations on the 3 shorts that we banked today for beautiful, beautiful profits. We banked our trade desk short. We covered that for 12.45%. We also covered our Qualcomm for a lovely gain, and we also covered our TEA and our team short. So you can see with the decline, we're slowly unloading some of our short positions, despite us still having many shorts on the table. One of the reasons I'm going to touch base on why I covered our shorts and throughout later in this video is simply because I do think the markets will have somewhat of a technical bounce. And there's a couple of reasons which we'll discuss. In this video, we're going to discuss the S&P 500, the NASDAQ, gold, natural gas, oil, the US dollar, of course, which is probably the most important influencing factor in the short-term markets right now, as well as the long-term picture. And then we will also touch base on Bitcoin at the end of the video. So starting with the S&P 500 here, overall you can see it's been a tremendous sell-off. As soon as we tag that 200-day moving average alongside with this downsloping trend line, pivot to pivot to pivot. That is a thing of beauty. You can see you had these gap fills as resistance, and right from that level we've rolled off tremendously. And when you actually factor in how much we've rolled off of, basically in the last 3 to 4 trading sessions, we've negated 25% of this rally. So that's the power of the sell side pressure, especially in bear markets. And that's truly what I have been calling for and believe. And the interesting thing to note as well is the volume on the S&P 500 today actually came in at 77.6 million. So it's not tremendously heavy volume, but the interesting thing is that it is the greatest volume day in over 2 weeks. So if you had to go back 15 trading sessions, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, pretty much negates this whole chunk of trading action, the volume on a volume basis. So as we start to see a sell-off, the big question is it going to be on heavy volume, which will be a more of a probable factor that the downside is likely to resume. But that being said, S&P now that we've sold off, we are coming into some short-term support. So what I think is going to transpire is we're going to fill this gap, I think, to the downside. You have, and this is why this is an important level, because you not only have this gap fill over here, but you do have this gap fill over here as well, around the 408. Let me just adjust that. So around the 408 level and around the 411.25-ish level. So tremendous amount of support. And then not only do you have this daily gap filled slightly below, so there's a lot of support confluencing in this area, which is why I think we're going to get a short-term bounce. I don't think the bounce is going to be, off to new highs and taking out this pivot. I do think that the bounce will be enough to maybe challenge the 200-day again, which is coming sloping down, so it'll be a little bit lower as to where we tagged it over here. And another reason as to why I think the markets will get a bounce is if we look at the DXY, that has been putting a tremendous amount of pressure on the overall indices. So you can see on the DXY, we've had a beautiful surge to the upside here with a little bit of a pause day over here. We ate through that pause day with another 4 beautiful candle surges to the upside. Now, in the short term, the US dollar has met my upside target for the short term. So over the next, say, 1 to 3 weeks. With that being said, I think since it has met that upside target, what we could see is now somewhat of a consolidation to digest this. And we could start chopping in this range where we have this high to this low as the US dollar chops and digests this large move that it has done. I mean, simply looking at basically June of last year, it's just been on a complete tear. And one of the reasons this is so bad for the markets or the global equity markets, is the US dollar is a form of tightening on all of those outside of America. It's a way that America exports their inflation to the rest of the world. And imagine what the inflation rate would be like if the US dollar wasn't surging against the other basket of currencies, like the G7 currencies. So one of the reasons why the DXY is such a bad factor if it's surging to the upside is simply it compresses margins of emerging economies and anyone outside of North America. Due to the fact that most trade happens in US dollars, it makes things drastically more expensive. And the interesting thing is that today, for I think the first time in 2021 years, we saw the or the euro lose parity, actually start to go lower than the US dollar. And currencies are a massive, massive market that is truly very, very important to pay attention to, especially when certain currencies get so out of whack in comparison to other currencies, like the dollar compared to the yen versus the euro versus, pretty much everything other than the ruble. So the dollar surging has met the upside. I think we get a small pullback, maybe to the bottom of this channel around 106, 107. And the reason why I think this will help the equity markets is because the US dollar puts a tremendous amount of pressure as money flows into this greenbacks, a safe haven asset. It flows out of the equity markets. And if we get a little bit of a pullback in the dollar, I do think that could find a little bit of reprieve for the S&P 500. And basically during the intraday action when I was watching the dollar, it was very similar in terms of the core intraday correlation. Every time the US dollar would get an uptick, the S&P would downtick. Vice versa, when the dollar would downtick, the S&P uptick. So strong correlation since the US dollar is surging at these levels. Let's take a look at the QQQ, which is the NASDAQ. NASDAQ is hitting support. You can see that the NASDAQ basically filled this gap to the downside and sliced through it like a hot knife through butter. And then you've also hit this gap fill over here, which you filled to a T, and you're getting a minor bounce off of that level. We actually day traded in the live day trade room for a small bounce, which in the near future, I will be launching my day trade room service, my live day trade, where you can hear me on the mic, calling out levels, prepping people for position sizing, and overall holding people's hand and guiding you to finding scalping opportunities, because honestly, day trading can be very, very profitable in an extremely volatile environment, which is what we have. So you can see the NASDAQ is at support. There might be a little bit more downside for the NASDAQ as it hits the low range of this channel. Let me just adjust this channel because it is slightly off. So you could see the NASDAQ float down to the low range of this channel. You have some flat top pivots over here and over here, and we'll just have to continue to see if that can happen. But again, if the NASDAQ catches a bid, it will also likely coincide with the US dollar pulling back or retracing lower. Let's take a look at WTI. Oil is basically finding support, hitting that level and starting to rise. It's around $90 a barrel in the WTI contract. I still think oil heads lower. I now have a price target that I think oil can fulfill by sometime by the end of the year, around the $76 mark. If it hits the $76 mark, that would be pretty much a great opportunity to start accumulating and going long oil. Now, bear in mind, you have to leave yourself maneuverability in a commodity trade like this, because if a nasty global recession takes hold, it could really send oil down to even these 62 levels and arguably around this 58 level, which was your initial surge from these lows, check back consolidation, then you never looked back for an extended period of time. So oil can go lower, so leave yourself maneuverability. Natural gas has the same concept around it, and natural gas actually had a very, very good pop. We added to our KOLD short pretty much at the highs of natural gas in the pre-market, and that's what I've been noticing. If you're in a natural gas trade, you have to I usually execute a lot of trades in the pre-market on natural gas because it tends to have it pops. It tends to have it find its tops during the pre-market on the light volume, and it tends to have its bottoms also in the pre-market. So finding those levels in the pre-market is very, very key. If it hits those resistance levels, you have to be very quick and switched on because it moves so fast. And the interesting thing is, one of the reasons why I think natural gas is so manipulated is if you look at when the downside happened, it was happening during the highest volume period of the day. Pretty much when we opened, there was just continuous downside pressure. And this is what I don't like about the natural gas trade is in the morning, the volume is so thin, it's very easy to prop the price up. And the same thing in the afternoon, the volume is very thin. Just due to the commodity markets, the NYMEX closing I think around 230, so it forces the commodity markets to have extremely light volumes in the morning and in the afternoon, and therefore it's easier to manipulate the price in the short term to either pop it or drop it, which is an interesting thing because we saw the sell-off in natural gas happening during the heaviest volume of the day, which is kind of a red flag to me. Considering you had this intraday volume, it was your highest level of intraday sell action during the day, but yet we still finished positive on the day. I am just not really believing this rally, which is why we're just slowly accumulating a nice core position in natural gas. I do think we're going to see this 665 area once again at some point in time. There's just a lot of news headlines around Putin, shutting down the pipelines and preparing to put a squeeze on Germany and Europe as the winter approaches in the near term. But believe it or not, Germany has all their natural gas. If you actually look at it, their stockpiles are decently elevated, and they have enough to get through, especially if we go into recession, especially if they've been diverting away from natural gas. So I just think this is in the short term, it's manipulated. Now, that being said, for the bullish side, I just analyze it from a macro standpoint and a technical standpoint based off of signals that I'm seeing. Now, I could be wrong, which is why you always have to know the upside levels as our next resistance levels. So the next upside levels that I see, if you simply look at this parallel channel that we've been trading in, you can clearly see we're approaching the upper end, which is around this 1028, 1030. I think we pierce to this 1040 level if natural gas gets a nice big surge in the next 1 to 2 days. But overall, tomorrow is a pretty important day. If we close above this previous pivot high, this wick high over here, then that does open up the possibilities and probabilities. It increases it in favor that natural gas sees this 1078 mark. And then at the high end of the target, this 1168 mark. So again, this is why we are accumulating slowly, not going all in at one level, even though I do think it's going to collapse. Because if natural gas starts to trend higher and get these news-based event pops, which one thing from my experience, 10 years in the markets, news-based events always come and go and they never last. So the technical price action and the fundamentals will always push it higher. And yes, there's still a war being going on, but all of the natural gas numbers have been artificially inflated over a number of years due to the fact of monetary and fiscal stimulus and low interest rates. And then when you factor in, we've had booming economies during those periods, and now we're seeing declining GDP all over the place. As countries shift away from natural gas, in my mind, I'm taking the contrarian approach where everyone thinks natural gas is going to go to $20 and $50 here in the States. I just think that's lunacy. And basically, the North American policymakers, i.e. the US and Canadian government, would never let their own natural gas go to basically $20 or $40 levels or $50 levels, which is what people are calling for. And simply when you think about it from a logical standpoint, they would, if they let natural gas, say, even double from these areas, and we think about it, natural gas is up about 500%, I think, in 2 years, starting from down here in June all the way up to this high. It's over 520%. So when you think about that, that is already compressing and squeezing margins of businesses here in North America. When you factor in, if they would rather save their own people or, Europe, I think they would cut off their own supply or create some excuse to try to tame their own domestic prices as opposed to trying to help Europe, which is honestly at the mercy of Russia. We can only do so much at this point in time because we don't have the infrastructure developed, because that was lack of planning over the last several years by policymakers in the G7 countries. So overall, I do think natural gas will eventually come down, but it does have the potential to climb higher around this 1040, 1078, and then this 1162 level. But those would be some pretty extreme swings, and it would have a mean reversion back to the downside at some point in time as we start to see price action and the economy deteriorate with weakening data potentially coming out. If we look at the home builders, ITB, again, we're watching this as a leading indicator. Massive down day. That's amazing to see considering we're short the ITB. But again, without the ITB making a run and finding some legs, it's going to be very difficult for the S&P and the overall economy to find a healthy point in time. Let's take a look at gold. Gold has been trounced. Tremendous sell side pressure on gold. 1, 2, 3, 4, 5, 6 days of downside, and we're starting to look to be another red candle over here. But on a probability basis, it does favor an update tomorrow in gold, which could correlate with the max move in the dollar. Since gold has sold off tremendously, the dollar has rallied tremendously, it could be a cooling off period for the DXY, and then a potential move higher for the dollar or for gold. Gold is at support, trading back in this original breakout zone. So overall, once gold starts to get its next leg up, it should have some pretty decent legs behind it as long as the US dollar doesn't have some sort of a blow off top. We did start picking up a little bit more of the Pan American Silver, PAS, so PAAS, and you can see what a thing of beauty. We added at this 1581 level. One of the reasons I added, if we simply go to the weekly chart, you can see we have this downsloping parallel channel connecting your pivot to what you just tagged today. Massive resistance zones up here. Let's flip back to the daily. You also filled a technical gap over here to the downside, which is why we also added more to our PAS position. And honestly, this has a tremendous amount of upside. Obviously, Pan American Silver has been crushed with the inflation trade, input costs becoming higher, but overall the dollar has been putting pressure on the metal space. So that is kind of why I think this will get that mean reversion bounce as soon as that dollar starts to cool off. And it's beautiful to see a nice reversal bottoming tail candle over here. Considering we added lower, it brought our average down. That is always a thing of beauty when we add at a very, very low point on the chart and it reverses off of that price action. So very interesting to see on that front. Let's take a look at the yields. So once again, the US 10-year yields are surging, which is why we're seeing an elevated dollar. Overall, you can see we offloaded our UBT somewhere down this 2.5 mark just due to the fact of not liking this pattern. Yields are getting somewhat extended. I would consider them to flounder sideways here, maybe chopping in between this orange trend line and this downsloping trend line. So we could start seeing some price action in this range, chopping here. Before, honestly, I do think it will start to break lower as the economy and we get more economic data that forces the Federal Reserve to be less dovish. But I do think we have to keep in mind that the Fed may not turn dovish for a little bit longer due to the fact that they're looking at lagging data like the unemployment rates, as well as the fact that inflation is still so crazy high. And I do think inflation will come roaring back at some point in time, especially since the Biden administration is depleting the strategic petroleum reserves for the last 6 months, and I think they only roughly have 5 to 6 more months supply, releasing another 1 million barrels a day. So even in a tightening period where the overall central banks are tightening, you have the fiscal side, so the government side, stimulating the economy still by releasing that extra 1 million barrels a day of oil. So imagine what oil prices would be like and inflation would be like, the CPI, considering in the CPI the only aspect of inflation that has been reducing is the energy side, and the more sticky components are the housing and the food, which are still increasing. So imagine if we didn't have those 1 million barrels a day flowing into the energy markets, the oil markets, what our gas prices would be, what our oil prices would be, what input costs would be for every single business. That's why if they keep depleting the SPR in 5 to 6 months, we won't have any oil to be stimulating the economy with. And then you'll have the aspect of traders and investors pricing in a United States government that needs to buy more oil in a time where there's no development going on and no infrastructure and no investment. So you have this catch-22 where it's great in the short term what's happening for consumers, but in the next 6 months when we run out, what happens to the price of oil? What happens if inflation keeps roaring back and the fiscal side of policy can't stimulate the economy by easing through releasing barrels of oil? It's going to skyrocket, which is only going to compress companies' earnings and margins more, which might be the overall catalyst in the next, say, 6 months, where I do think we find a massive bottom or a significant decline in the SPY. I have it priced in that at some point in time, I do think we see somewhat of a crash. I do think we have it priced in to go back to this previous COVID high. And that could coincide in the next 6 months when we run out of oil in the SPR and inflation comes roaring back. And then what? The Fed has to basically raise interest rates even higher. That would crush the overall high beta indices and basically anything. And if we analyze what transpired, last night we were prepping and we've been touching base on the utilities. Utilities are such an important factor for the economy. If we simply look at what happened and what transpired in the utilities, we put out a chart last night explaining why the indices are likely to roll over and why we're likely to see downside. And this is kind of what I'm expecting to happen, this similar pattern. And you can see when we hit resistance, so this is a massive, massive channel that we've been trading in for quite some time, multi-year channel, parallel channel, might I add that. And you can see you hit the previous high here and you've pulled off. But basically the S&P during that first quarter or that second quarter sell-off, that nasty sell-off, the S&P topped right around here on the 29th of March. Utilities rallied for a few more days, hit resistance, and then the indices just started to roll over hard. Typically from this point in time when the SPY started rolling over in March, you see money rotate more defensively into utility stocks. And then when you actually start to see utilities soften and weaken, that is generally the red flag in the markets that these are likely, very likely to head lower. And this is kind of what I'm expecting. We're at this very similar point where utilities are starting to roll over. You could have a little bit of a bounce here, consolidation, a test of the double top, and then a big failure. This is what brought on the last sell-off, major sell-off in the second quarter of 2022. And I think we're at a very similar point in time where utilities are once again making that initial drop and we could consolidate, come up to test this again, and then fall. And that's why I do think the markets will get a short-term potential bounce as the dollar starts to slip back. This could flag a little sideways, make a little run up for double top, and then crash again. But utilities are a huge leading indicator. We knew resistance was coming into play and tagged multiple days, which is why we were accumulating short positions, because the short moves happen fast and they happen furious. I just want to see if we need to discuss anything else at this point in time. We did do a couple new trades like FCX. So Freeport, one of the reasons I still like Freeport McMoran copper mining play is simply because you still have this inverse head and shoulders playing out. And if my theory is right that the US dollar has in the short term over the next 1 to 4 weeks reached a short-term high, that double top area, this should help the commodities propel itself higher and potentially help Freeport complete this inverse head and shoulders pattern, which takes it to about 34.70 is my upside target. And you can see Freeport actually had a nasty sell-off today and reversed, putting in this bottoming tail, which is an awesome thing to note because you actually closed with inside these wicks over here, which is a short-term bullish factor. It's saying this, the people that bought in here are actually willing to carry this price higher and not dump it as the markets head lower. And if you look at why I think we're also going to get a bounce, copper is actually holding up relatively well, even with the recent decline in the S&P and a strong surging dollar. Copper's held, and this is still a bullish uptrend, trading above the 50 daily moving average and just holding that level. So I was really impressed with the price action of copper today, considering the markets were selling off, consider the US dollar was surging tremendously, and considering yields were also surging tremendously. Typically, three catalysts that generally take copper down had no effect on copper in the short term today, which is a short-term bullish factor. And really, it's an interesting intermarket analysis of observation that I think will help to be a profitable trade for us once again. And copper upside, I think we get a retrace back to these pivots over here. The interesting thing about copper is you have a beautiful pivot over here, you have some resistance over here, and you also have a little bit of resistance over here. So around this 390 to 395 level is where I think copper can rally to, which would honestly still be in copper, especially if the US dollar falls, which would still be another 6 to 7% of a rally in the upside commodity, which would actually light a big fire under FCX, as the miners are always leveraged to the underlying commodity that they trade with. Overall, it was a tremendous day, hitting new highs on the account. So congratulations on that aspect of the trade. I think we also bought SE today, so let me just, or maybe that was just myself in the day trade room, but there's some stocks that have had tremendous moves down, for instance, like this SE, and they're now actually coming into support. You could see a little bit of a flush to this gap fill, but look at these moves down. And these are the stocks that affect the IWM, but you've had ever since you put in that nasty reversal candle, you've had just downside, tremendous 1, 2, 3, 4, 5 days of downside, and you've actually gapped. You've created a gap there, you've created another gap here, you've created another gap over here, and you have a gap here. So I do think you can fill this gap to the downside, which would actually be an interesting buying opportunity, considering that SE is still tremendously down from its highs, and it looks to be putting in a little bit of a base. Overall, do I think you break this pivot eventually? Yes, I do, but I think the indices have to be about another probably 5 to 15% lower, in and around that range. But overall, interesting price action there too. I just want to say congrats on the trades. New highs on the account is always awesome to see. It just proves to us that we are doing the right thing each and every day by accumulating at technical levels, reading the charts, and not holding a bias to one specific outcome or one company. And honestly, just reading the charts, because the price action is more powerful than any fundamental analysis. Any thorough analysis that you do of a company in the short term can often not have an impact. And that's why TA is the most powerful form of analyzing stocks, I truly believe. And it's a very fine line in terms of how you read charts. There's little nuances that can make or break your trades by whether a stock closes a penny to the upside or a penny to the downside. So it's important as much as you can to fine-tune and refine what TA works for you. There's multiple aspects of technical analysis that I'm still even learning as I trade each day, because the markets are evolving. But if you find strategies in TA and you sort of back test them and they work for you, and you incorporate position management, then starting to execute trades on those key factors will truly provide an exceptional opportunity to build your wealth. And honestly, what I'm doing is, this is my full-time job now. So I trade and this is my income. So I have to be serious in nature, because it matters whether I'm taking a salary home at the end of the month or not. So again, thank you all for being members. Sorry for going off on a little tangent there. Let me just touch base on the SPY just to see kind of what I'm expecting. What I'm expecting on the SPY is, if we get a little bit of a surge in the dollar, we could see a final little bit of a small flush down to this gap fill. I see a little bit of a technical bounce, potentially filling this gap up here, and then eventually starting our next down leg. And this down leg, I think, is going to start as soon as we hit that September period, where volume and big time institutional traders are back from vacations with their families, and they take the autopilot off the investment accounts. So tons of action most likely going to occur in September. Will the markets fall in the fall? That is the big question. I certainly think they have a likely chance of doing so. So that being said, again, please give this video a big like. Put a comment down below if anything wasn't clear, or if you would simply like my opinion on a stock or company. I'm happy to do some charting. Thank you all again. We'll see you on the charts tomorrow.